The Rebel Capitalist Show.
We always talk about gold compared to its main competitors, being the dollar and I believe the 10-year treasury. And you say kind of the catalyst for gold continuing to go up in this bull market we're in right now. And I think that's on everyone's mind. Is the bull market going to continue? Are we at the beginning? Are we at the end? What inning we're in? But going back to the 10-year, there's a lot of tailwind for gold if we've got negative real rates. So first of all, if you could explain that and how that's worked historically. And then when we get done with that, I've got kind of a curveball that I want to throw at you and see if it's kind of pick your brain a little bit.
Well, I look forward to that. Pick it with a small fork, but we'll get to it. With regards to unpacking the first part of the statement, for as long as I've been in the financial services business, which is to say in excess of 45 years, all financial assets in the world are priced off the world's benchmark security, which is the US 10-year treasury. It is, in fact, the security that all other securities are valued against. It's the largest, deepest, and most liquid savings and investment asset in the world. Gold moves for many reasons, most of which have to do with fear early on in the gold move. Later, it can move on momentum. But the most common fear that moves gold, and has for centuries, is fear of the degradation of the purchasing power of other savings instruments, particularly denominated in reserve currencies, like the US dollar. So when people are concerned about the stability of the purchasing power of their savings over time in the US 10-year treasury, gold does very well. So I suspect that there are several factors behind gold's move right now. The first is, as you say, negative interest rates. The idea that your risk premium associated with lending money to the US government is that they pay you 50 basis points in a currency that they acknowledge is depreciating by 160 basis points a year,
right,
means that, as Jim Grant describes it, the chief competitor to gold offers up return-free risk. Not very attractive. Think about that concept, return-free risk.
right.
This is the first promise that I can think of that my government has ever made me that's going to come true. They solemnly swear to give me back less money than I gave them at the beginning of the exercise. And I believe they'll keep this promise, and I'm not happy about it. The second factor, of course, is quantitative easing. The printing of, or they don't have to print anymore, the creation by keystroke of specious, spurious currency. If you did this, if you printed gammons or something like that, it would be called counterfeiting, and you would be a guest of the state in prison, in less nice accommodations than you have today. So the debasement of the currency obviously is very tough on the ongoing purchasing power of the currency. And the final is really related to that. It has to do with debt and deficits. We talked the last time that I was on your show about a year ago, and I was horrified that the on-balance sheet liabilities of the federal government exceeded 20 trillion.
Right.
Now they exceed 24 trillion. And in fact, in the month of July, the number went up by $850 billion. We incurred more debt in 1 month than we incurred in the first 200 years of this country's existence.
Yeah.
That makes people concerned too about the ongoing value of the purchasing power. But there's one more thing, George, that I think that your listeners need to examine. Many commentators, including, of course, Casey and Rogers and them, have commented on the deterioration of the purchasing power of the dollar as being responsible for gold strength. But there's another thing that people need to understand, which is that gold is underowned. Precious metals and precious metals related assets comprise less than 0.5% of all savings and investment assets in the United States. That's down from an estimated 8% in 1981.
Wow.
But importantly, it is way low than the 3-decade mean, which is between 1.5% or 2%. In order for gold to do well, in order for gold to hold its purchasing power, It doesn't need to regain its former panic-induced market share. It just needs to return to the 3-decade mean.
Mhm.
If gold reverts to mean, which I believe it will, demand for precious metals and precious metals equities would go from less than 0.5% to 1.5 or 2%, which is to say that demand would triple or quadruple in the largest savings and investment market in the world. And I think that people need to bear that in mind too. The fact that gold is ludicrously underowned in a circumstance where the wind is in gold sails.
Yeah, and expand on that a little bit, because I listened to a podcast you did the other day, and you were talking about how you kind of have an insider's view to what institutional money is doing right now. And you said going back to 2012, you guys were trying to pitch physical gold or your Sprott product to these institutional investors, and they weren't even giving you the time of day. And now all of a sudden, I think it's as of maybe a year ago or 12 months ago, they're calling you and life is good. And so is that kind of the first step that we're seeing towards that number you just talked about changing in favor of gold and the gold price?
I think it is. The narrative was in place for gold in 2011, 2012. But the extremes that we're seeing in terms of the policy response to the economy and COVID are so extraordinary now
Yeah.
that conventional investors who have had no use for gold are acting on the thesis. The second thing is that in 2010, 2011, 2000 gold, it was very obvious that there was room to cut the interest rate on the US 10-year Treasury, which meant that although the yield return was paltry, the prospect of capital gains was 100%.
Yeah.
If the 10-year Treasury was yielding 3.5 and it was pretty obvious that they were going to take it down to 1 or 0.5, it meant that there were capital gains to be had on the US 10-year Treasury that still made the US 10-year Treasury efficacious for very large investors.
Yeah. Even if at a negative real rate.
Right. How low can you go now? And what is your holding cost? It may be that there are capital gains left in the US 10-year Treasury. But the truth is, George, if you look at the 35-year history of the US 10-year Treasury, in 1981, which is to say the high point for gold and the low point for bonds, the US 10-year Treasury was yielding 15.5 or 15.6. Now it's yielding 50 basis points. We've had a 35-year bull market in the US 10-year Treasury. If you believe, like me, that the interest rate can't go much lower, then you believe the bond can't go much higher.
Right.
And I think it's very clear to these huge endowments and pension plans whose primary asset has been US Treasury securities, that 35-year bull market is over for very good reasons. These aren't dumb guys who run these huge endowments. And the concept of return-free risk is not very attractive. Think of yourself running a large endowment, and your actuarial assumptions are that you have to earn 7.5% a year to preserve the purchasing power of your retirees in their retirement. And try and figure out how you do that with a 50 basis point yield in an instrument where the purchasing power is declining by 1.6% a year. You have to overcome a 1% negative bogey.
Right.
At the beginning of the exercise. It's very, very, very tough to do. And when these managers are looking at a market and they can tell that it's fundamentally changed, they become much more open to new ideas. Now, the narrative that we're talking to them about is the same narrative we've been talking to them about for 10 years. It's just that the arithmetic has caught up with the narrative.